Have you ever wondered about the current state of inflation and its impact on your everyday life? Well, let's dive into this fascinating topic. Inflation, in its most basic form, represents the rate at which the general level of prices for goods and services is rising. It's like a tide that gradually lifts all boats. But in this case, we're talking about prices, not boats. Now, how do we measure this tide? There are several tools, but the Federal Reserve, the central banking system of the United States, favors one in particular: the Core Personal Consumption Expenditures Price Index, or as it's more commonly known, the PCE Price Index. This index measures the prices paid by consumers for goods and services, excluding volatile food and energy prices. It's a bit like taking the temperature of the economy, giving us a sense of whether things are heating up or cooling down. Recently, this economic thermometer marked a 0.3% rise, following a robust 0.5% increase in January. This back-to-back gain is the largest we've seen in a year, suggesting a steady but moderate uptick in inflation. But what does this mean for us? Well, a moderate increase in inflation can signal a healthy economy, with businesses feeling confident to raise prices and consumers willing to pay a bit more for their purchases. However, the Federal Reserve officials are treading carefully. They see this mild increase in the narrower gauge of services inflation as a comforting sign, but they remain cautious, seeking more evidence that inflation is moving in a sustainable downward direction. They're not rushing to cut interest rates just yet. It's a bit like a chef carefully adjusting the heat under a simmering pot, making sure it doesn't start to boil over. As we see, a steady but moderate uptick in inflation signals a nuanced economic landscape. It's a delicate balancing act, with the Federal Reserve playing the role of the tightrope walker, carefully navigating the fine line of inflation to maintain economic stability. The Federal Reserve officials are not just spectators in this economic play. They're the conductors, keenly observing the orchestra of economic indicators, of which the Core PCE Price Index is a key player. This index, a preferred measure of underlying inflation, rose by 0.3% last month, following a 0.5% increase in January. This sequence of gains is the most significant we've seen in a year, and it's signaling a steady, albeit moderate, uptick in inflation. But the Fed officials are not popping the champagne just yet. They see a glimmer of comfort in the slight increase in a narrower gauge of services inflation within the report. However, they're keeping their celebration in check, maintaining a cautious stance and seeking further evidence that inflation is moving in a sustainable downward direction. Their prudence is reflected in their reluctance to cut interest rates. They're not rushing to make this move. Instead, they're adopting a wait-and-see approach, carefully weighing the potential implications of any rate adjustments. On the other hand, they're not turning a blind eye to the positive developments in the economy. The report from the Bureau of Economic Analysis indicated that inflation-adjusted consumer spending exceeded expectations, pointing towards robust economic activity. This uptick in consumer spending, bolstered by strong wage growth, is a silver lining amidst the cloud of inflation concerns. The largest increase in wages in over a year has fueled this surge in spending, giving the Fed officials something to cheer about. However, the cooling inflation reading offers a welcome relief after earlier data hinted at heightened price pressures at the start of the year. But again, Fed officials are keeping their guard up. They're awaiting more concrete evidence of a sustained decline in inflation before making any significant policy adjustments. In essence, they're playing the long game, carefully observing the ebbs and flows of economic indicators before making their move. While the Fed finds some comfort in the mild increase, they remain on guard for further evidence of sustainable inflation direction. Now let's shift our focus to the consumer side of the equation. In a delightful turn of events, consumer spending, which had previously taken a bit of a tumble, has made a strong comeback, surpassing all prior estimates. Now that's quite the comeback story, isn't it? It's like the underdog of the economic indicators, staging an unexpected rally when the odds seemed stacked against it. But what's behind this surprise rebound? Well, one of the key drivers is the substantial wage growth we've been seeing. It's been over a year since we've seen wage increases of this magnitude. People have more money in their pockets, and they're not afraid to spend it. It's a classic case of more money, more shopping. Now, this isn't just some random spending spree we're talking about. This increase in consumer spending is a sign of a robust economy. When people feel secure about their financial situation, they're more likely to spend rather than save. This spending, in turn, fuels more economic activity, creating a virtuous cycle of growth and prosperity. But let's not get too carried away. A single month of strong consumer spending doesn't necessarily indicate a long-term trend. However, it's certainly a positive sign, a glimmer of hope in an uncertain economic landscape. It's like a beacon guiding us towards potentially calmer waters. So, what does all this mean for you and me? Well, on a practical level, it means that businesses could see increased sales, which could lead to more jobs and potentially even higher wages. It's a ripple effect that could benefit everyone. On a broader level, this rebound in consumer spending sends a powerful message. It shows that despite the challenges, the spirit of the consumer is resilient. It's a testament to the strength and resilience of the economy, a symbol of hope and optimism in the face of adversity. Strong wage growth seems to be playing a pivotal role in driving consumer spending, indicating robust economic activity. The Bureau of Economic Analysis has also weighed in on these developments. They've been keeping a keen eye on the rise and fall of economic indicators, and their recent report provides some valuable insights into the current situation. The Bureau's report analyzes the latest wave of consumer spending, which, after a period of slowness, has bounced back with a vigor that surpassed all estimates. This upward trend in spending is a strong signal of an active economy. It's an important point to note because consumer spending, in essence, fuels the economic engine, driving growth and prosperity. Interestingly, this rebound in spending didn't occur in isolation. It was accompanied by a surge in wage growth, the largest we've seen in over a year. When people earn more, they tend to spend more. So this increase in wages has likely played a significant role in boosting consumer expenditure. But what's particularly noteworthy about this spending surge is that it's not just a nominal increase. The Bureau's report indicates that inflation-adjusted consumer spending has outpaced expectations. This means that even when we account for the effect of inflation, consumer spending is still robust. It's a clear indicator that the economy is more than just holding its own, it's thriving. The Bureau's report also offers a fresh perspective on inflation. Earlier in the year, there were concerns about rising price pressures, but the latest data offers a sense of relief. The inflation reading has cooled, suggesting a more moderate and manageable rate of price increases. This is good news for Fed officials who've been looking for signs of a sustainable downward trend in inflation. It's clear that the Bureau of Economic Analysis has a positive outlook on the economy, based on these recent developments. The rise in consumer spending, backed by strong wage growth and a moderate inflation rate, paints a promising picture for the future. The Bureau's report provides a positive outlook on the economy, with consumer spending outpacing expectations. So, where do we go from here? It's important to look back and recap the noteworthy points we've covered today. The Core Personal Consumption Expenditures Price Index, a favored measure of underlying inflation by the Federal Reserve, has seen a moderate uptick. This upward trend is marked by the largest back-to-back gain in a year. While this increase might raise some eyebrows, it's crucial to note that it's a mild one, signaling a steady but moderate rise in inflation. The Federal Reserve officials, known for their prudence, find some comfort in this mild increase. However, their optimism is cautious. They're on the lookout for more evidence that inflation is moving in a sustainable downward direction. It's clear that they aren't rushing to cut interest rates, a move that would signal a more drastic concern over inflationary trends. On the flip side, we've seen a positive rebound in consumer spending, surpassing all estimates. This rebound is a result of strong wage growth, marking the largest increase in wages in over a year. The Bureau of Economic Analysis has reported that inflation-adjusted consumer spending has outpaced expectations, indicating robust economic activity. The cooling inflation reading brings a welcome relief, especially after earlier data suggested heightened price pressures at the beginning of the year. But the Federal Reserve officials are far from complacent. They remain vigilant, waiting for more concrete evidence of a sustained decline in inflation before they consider making significant policy adjustments. Looking forward, it's clear that the Federal Reserve is committed to maintaining a balance in our economy, a balance between keeping inflation in check and fostering economic growth. It's a tightrope walk for sure, but one that they're adept at navigating. As we navigate through the complexities of our economy, we remain hopeful for a sustainable economic growth, keeping a keen eye on the inflation and consumer spending trends.